What's going on, everybody? Welcome to Ryan Pineda Show. We talk all things money, real estate, and entrepreneurship. And in today's episode, we are going to be going over why rental properties help me significantly lower my tax bill. So for this video, I actually brought my partner Matt from TrueBooks. For those of you who don't know, I actually own a tax company. It's called TrueBooks, like I just said, and we help real estate professionals all across the country. And the reason we started the company was I had so many issues with other CPAs before I met Matt. And by the time we had done mine the first time, I just was like, dude, we need to start a company because this is needed everywhere. And so we're really happy to be helping everyone else out. And instead of just hearing me talk about taxes, I figured I'd just bring in the professional to do it.
Well, hey Ryan, thanks for having me. I'm glad to be on the show, and I think we'll bring a lot of value to your viewers.
So I've actually encouraged Matt to start a YouTube, and he's now done that. So we'll link to his YouTube in the description below. If you're just looking for tax advice, he will be giving it to you. So before we get into the tax side of things on how it can actually lower your tax bill, let's first address why rentals are so great and why people like to get them. So the first one that we all know about is cash flow. That is simply how much money you make on the property every single month. You would simply take how much rent you get minus all of the expenses with the mortgage, the rehabs, the maintenance, all that stuff. That's what most people think the benefit of rentals are, but that's only just one little piece of the pie. Second one would be principal pay down. So your tenant is essentially paying down the principal balance on your mortgage every single month that you own a rental property. And this is why it's so powerful, because not only are you making monthly cash flow, you're gaining equity each and every month, even if it doesn't appreciate because of principal pay down. And the last one that some people think about is appreciation. Historically, real estate has always appreciated, so when you combine all three of those things, you're getting principal pay down, you're also getting appreciation, and appreciation is great, especially if you pick the right market where appreciation just really takes over. But those three things alone make rentals worthwhile. If you can make a consistent check every single month with the cash flow, you're gaining equity through appreciation, but also through principal pay down, you can see how your net worth is gonna grow tremendously. But what people don't know are all the tax benefits as well. So I'm gonna let Matt talk about all the different tax benefits, whether you have one rental or you have 100.
The very first tax benefit that I want to talk about is interest expense. The first thing that's going to help you lower that tax bill from the rental income that you receive is that interest expense deduction that you're going to be able to take when you finance the property. For a lot of people, when they buy a rental property, they're going to finance a portion of it. And along with that financing will come interest. And you get to write off this interest every month that you pay the mortgage.
So are you saying that you can write off all your interest?
Yes.
So if I'm able to write off everything, like how much are we talking the write-off is on, say, like a $300,000 home?
Well, I could go run the math for you right now, but I know that, well, to stay out of the details, I would say on average you could get $6,000 to $10,000 in interest expense.
So if you're talking $10,000 and you're at the 20% income tax bracket, you're gonna save what, $2,000?
$2,000 right there for the interest that you pay.
So that's just one way that we save taxes. What's another way?
The next biggest benefit is depreciation. Similar to how you hear when you buy a car and drive it off the lot, it's worth 30% less. It works that way with real estate as well. With a single family home that you typically would buy as a rental, you get to depreciate that portion over 27.5 years. With a commercial property, it's 39 years. For example, if you buy a home for $100,000 and we say maybe $10,000 is the land, we would say $90,000 is the value of the building. This is the value that you would depreciate over 27.5 years.
So what you're saying is that the $90,000 gets divided by 27 years, right?
Exactly.
So essentially it's around $3,000 a year that you get to depreciate.
Exactly. And the best part about it is you don't really pay cash for this expense. It's a non-cash expense, but it's still tax deductible.
Now I've heard about this a lot, and we've actually used it for me a little bit. Like, tell them about cost segregation.
Okay, so cost segregation is when that same example of the building for $100,000, if we allocate $10,000 to the land, $90,000 to the building, that wouldn't be that accurate because that $90,000 that you're including in the building really includes the paint, the carpet, the cabinetry, and things like that that depreciate over only maybe 5 years or 7 years, not 27 and a half like the building.
So essentially what you're saying is the building and things that last a really long time should be 27 years, but the small things that wear and tear really quick, like paint, which we all know with rental properties could be every couple of years. Every time a tenant moves out, you got to repaint it. You're saying that those can be depreciated far quicker.
Exactly. So not only do they have quicker depreciation lives, but you can actually bonus depreciate them, which is where you may have heard the term cost segregation study.
So tell me, what is a bonus depreciation?
The simplest way to define bonus depreciation would be, let's say you buy a set of cabinets. That would typically be depreciated over 5 or 7 years. But because of bonus depreciation rules, you're able to take that full expense in year 1, not over 5 or 7 years. So as Ryan pointed out, on a $90,000 house over 27 and a half years, that may only be about $3,000 a year. Bonus depreciation allows you to write off the whole asset in the year that you purchase it.
So let's just say that I buy a property that I'm rehabbing, right? I'm going to use the BRRRR strategy on it. I go and spend $30,000 putting in new flooring, new cabinets, new paint, all that stuff. Are you saying that I'm able to write off the $30,000 that year?
Yes.
And so you guys can see how that can really limit my tax bill if I can write off $30,000 right now. Because take, for instance, I go and flip a property and make $30,000. Well, if I buy a rental and go put $30,000 into rehab, I've essentially created a wash where I've made nothing on paper.
And the best part about depreciation is, again, it's a non-cash expense, but you get the tax deduction. So at the end of the year, you could be cash flowing on a property, but yet still show a loss on your tax return. And one of the best things about having rental properties, even though you may be a W-2 employee, is you can actually use some of those rental losses from the properties to offset your W-2 income. For example, you might make $50,000 on a W-2, but after depreciation, your interest deductions and things like that, you might have a loss on the rentals of $10,000. Now your $50,000 W-2 really looks like $40,000, and therefore you pay less tax.
Well, what happens a lot of times too is you didn't really have a loss cash flow wise. You just had a paper loss.
Exactly. So back to that depreciation, it's a non-cash expense. You're not actually paying for it, but yet it's a tax deduction on your tax return.
Yeah, and I think depreciation for me as a flipper who's active and doing these big rehabs is easily the biggest thing for me as far as my tax write-offs go.
And we see it all the time. Some of the bigger players, when you start to have more money to invest in some of these syndications, I've seen clients invest, let's say $100,000 into a syndication that they plan to do a big cost segregation study on, and he'll expect to get, let's say, 2.5 to 3 times the loss in the year that he invested. So for example, you could invest $100,000 into a partnership and show a loss on your tax return from that partnership of $350,000 through a cost segregation study on a massive apartment building.
And this is why you see the big guys like Grant Cardone and everyone else buying all these apartments. They're doing them not only for the reasons we talked about with cash flow and appreciation and all that, but they're doing them to basically get rid of their income. So I love depreciation, but I kind of talked about another strategy that I use, which is BRRRR. And think about how BRRRR works on the tax side. If I go and put all that rehab into a property, I'm going to bonus depreciate it, get that write-off, but then I'm also going to refinance the property later on. And what happens with that refinance is I get all the cash back that I've put into the property. So what happens with the cash that I get back?
It's tax-free. It's at will to do what you want with it.
So that is one of the only things I've ever seen where I could pull out a ton of cash, especially if I got a really good deal, and literally pay no taxes on it.
Exactly.
I've even seen it with a lot of these apartment guys where they will put all this money into the apartment, they're getting to write all of that off, they're forcing appreciation, and then they go and refi, and they get like $1 million back tax-free. It's crazy.
And when you think about it, it's because it's not really income, it's just simply you're taking on more debt to now cash out refi. So what happens in turn? Your interest expense will go up, which further creates a bigger tax deduction.
Yeah, so it's the circle that makes it so you should buy real estate, you should renovate it, and then you should refinance it because you're gonna get all the benefits of doing that. And so everything we're talking about today can apply to anyone. You don't have to be a full-time real estate investor. You don't have to be this big millionaire guy. Anyone. He said with a $50,000 W-2, you can get these same deductions that I get. Now, there are a lot of other deductions that I get being a real estate professional that you guys don't if you're not. And I don't want to cover that in this video because that can be a whole video on itself. So here's what I'm going to do. If you guys like this video, make sure you like it, make sure you share, make sure you subscribe to this channel, make sure you subscribe to Matt's channel. And if we get enough love, we will do another video about why being a real estate professional can increase your tax deductions even further. So to summarize what we learned today, buying rentals not only can get you cash flow, can get you principal pay down, and can get you appreciation, but on the tax side, they can help you a lot as well.
Through interest expense, the magical expense of depreciation, and cash out refi.
And if you guys want to work with Matt, he's the best. I'm just gonna go out there and say it. There's a lot of great CPAs. I've also had to go through a lot of CPAs to find Matt. I wouldn't partner with anybody that I didn't believe in. So if you need tax help, make sure you go to TrueBooksCPA.com. You can find the link below. You can schedule an appointment to talk directly to Matt, and he'll help you out and give you advice on what's the best strategy for you going forward.
Not only do we do tax preparation, we do tax strategy, we do bookkeeping, we do accounting, any type of financial consulting that you need.
Well, cool, man. I appreciate having you on. If you guys like this, like I said, let us know. We'll do more sessions just like this. Anyways, make sure you guys go subscribe. Take care.